Okay, today is Monday, April 21st. This section is being recorded for video for everybody else to watch. This week, we are going to start the fourth section of our class, which is on multiples. And so basically, we're going to do three things today. One, we will talk about sort of multiples from our lecture notes. Two, we'll kind of do an in-class example of how to analyze the multiples. And three, we'll set up your homework assignment, which is due on Wednesday. And just because of the holiday weekend, and I know everybody may have trouble getting back to campus in time, so I'm going to give you all of the screenshot data required to do Wednesday's assignment. So you won't need to go in the lab to do Wednesday's assignment. You can do it all from home. However, that is the roadmap for next Monday's assignment on multiples, and you will need to go to the lab to get that data, which again, will in Wednesday's class, we'll announce that assignment, which is the final homework of the year, which is essentially a credit assignment, but is still mandatory to be done. So as we kind of get towards the end of the semester, fewer and fewer assignments left as we get into the home stretch. All right. Before we jump in, any questions about anything? All right. So again, the session is being recorded. So I'm going to start out with the lecture note 4. And I want to just talk about multiples, also known as comparables. It's just an alternative form of valuation. But when we get into multiples, I want you to understand that the law of one price still applies, meaning there's one value for a company. And whether you do an enterprise DCF cash flow valuation of a company, or whether you do a multiples valuation of a company, you have to get the same answer, right? So regardless of your approach, the value does not change, and it should not change. And so this is really just, in a nutshell, rearranged math to try and get to the same valuation. But the major difference about multiples is also known as comparables, is that with a DCF, we start with the idea of a theoretical value of the company, meaning if they generated these cash flows, what would the company be worth, right? With a multiple analysis, we actually start with the price, right? The price is the price. We know the actual price of companies in the markets today. And so in a way, we're kind of working backwards. We're going to say, okay, given the price, what cash flows lead to those prices? But what we also do is we compare them to similar things of similar prices. And what I like to tell people is that your first probably real world multiple that you'll start to deal with is if you ever buy a house or get an equity loan, home equity loan on a house. Because the first thing they're going to do is they're going to appraise the house, right? And the appraisal for a house is a comparable analysis, right? Matter of fact, what they're going to do is pretty straightforward. They're going to look at, first they're going to start with what is the appraised value of similar homes that have sold in your neighborhood, typically in the last 6 to 12 months, right? So what was the sales price of all of those homes? And then they know the square footage of all of those homes, and the appraiser's literally going to divide. They're going to take the average sales price divided by the average square feet, and they're going to get a price per square foot, right? And that is essentially a multiple, no different than a price to earnings multiple. And then they're going to take your square footage of your house that you want to sell, and they're going to multiply it by that price per square foot to get the baseline of the appraisal. Okay, so just simply, house is worth 400. Average house is $400,000. Average house is 2,000 square feet. 400,000 divided by 2,000 is $100 a square foot. So if your house is 3,000 square feet, you multiply by 200. That's an appraised value starting out at 600,000. And then what the appraiser is going to do is it's going to adjust. It's going to adjust based on that baseline up or down, meaning Are you on a bigger lot than the average size house? Are you in a more appealing lot? What's the age of your house? What's the condition of your house? Were there any upgrades that were done to your house? What kind of school districts are you in? All those factors will kind of move around that number slightly higher or lower, but that's the idea. What we're going to do is we're going to use similar things to say, this is the value of the house, right? And essentially, the same thing is going to be true when we look at companies. And so what you'll find is that multiples are useful not only for valuing public companies, but also potentially valuing private companies. So for example, if I want to take a company private, I can say, okay, well, what are similar companies that are publicly traded selling for? And then I could say, based on that, this private company should be worth that if it were on the open market, right? And so it's a relatively straightforward approach. We can also do it for mergers and acquisitions, right? So if you're trying to figure out what should I pay for somebody, well, you can look historically at what price premiums were paid in your industry for different levels of M&A. And that might help you understand what type of M&A purchase price premium would be justified for the asset that you're doing. So essentially, the advantage of multiples is they're easy. The disadvantage is that they're easy and issues will come up. But one of the most important things, and it sounds pretty straightforward, is actually finding a similar range of companies, right? And that is actually the most difficult thing, is to find what is truly comparable, right? Now, every now and then you get companies that are pretty straightforward. Like if I'm doing Royal Caribbean against Carnival, that's all they do is cruise ships. So those companies are very, very comparable. But you know who's a competitor of Royal Caribbean? Disney. Disney has a pretty big cruise line, right? Well, the problem with Disney is that cruise line is just a small portion of their business. They got theme parks, they got movie studios, they got Disney Plus. They got a lot of stuff going on at Disney that has nothing to do with the cruise industry. And so the problem is when you're comparing Royal Caribbean to Disney, it's not the ideal comparison because Disney's doing a lot of other things, yet that's what we do. Matter of fact, if you're doing streaming, you look at Disney against Netflix. Again, Netflix doesn't have theme parks. Netflix doesn't have a cruise part of their industry. So the problem with multiples is finding truly comparable companies. As easy as it sounds, not that easy in the real world. Okay. But nonetheless, it's something we're going to have to try and do to try and figure out what the companies are worth. We're looking for things that are similar. And we'll talk to you about some of the trade-offs we're going to make, as well as understand that it's a trading range, because multiples are somewhat dynamic, meaning prices are changing every day. And so understanding that this is not a world of absolutes. All right. So again, I gave you the advantage of multiples is they're kind of simple. So it's the shortcut to the cash flow valuation. But the challenge is, as we just said, is that number one, because it is a shortcut, finding the comparables is not always easy. And two, if companies have some outliers that are happening to them, that also could make a difference. But the other part is, even when you're looking for similar companies, finding companies of similar size matters. Meaning, let's say we're doing social media companies. Well, you're going to look at probably Meta/Facebook if you're doing social media. Yet if I'm a social media startup, then is that really a true comparison against a behemoth like Meta? And again, it starts to get a little bit more challenging when you do multiples. So one of the better practices, which we talk about in the book, is essentially that what you really want is you want companies that do similar things based on similar levels of growth, similar levels of ROIC, and similar cap structures. Meaning you don't want to have a startup growing at 30% a year comparable to a mature company that's growing at 2 to 3% a year, right? That's much more problematic, even if they do slightly different things. Okay. So finding those companies is ideally a little bit better. Okay. All right. So steps in the process are relatively straightforward. Step one, find a bunch of peers, right? Preferably ones with similar operating and risk profiles. Number two, get your data from a data service. We're going to use Bloomberg. Number three, calculate the multiples. Bloomberg does this for you. Number 4, benchmark against the ratios and understand what's going to drive the multiples, which is part of your homework assignment, and then essentially figure out those differences and understand how it affects valuation. Best practices. Number 1, choose companies that have similar prospects for ROIC and growth within the same industry. Use forward-looking multiples, not historical-looking multiples. As you just saw in the valuation part of the class, companies are worth their future cash flows, not their historical cash flows. So historical multiples are not as predictive of value as future multiples, meaning I don't want to look at multiples based on 24 earnings. I want to look at multiples based on 26 earnings, given that we're in 2025. That would be more representative of the longer term future of a company, right? And the third one is enterprise value multiples tend to be more preferred over price to earnings multiples because they mitigate some of the cap structure problems with PE and tend to mitigate gains and losses one times that not saying they're perfect, but they tend to equalize it out a little bit better and adjust, meaning every now and then you're going to run up with a company that's an apple and an orange. And speaking of Apple, like if you look at Apple's multiple, one of the challenges with Apple is they got $200 billion of cash sitting on their balance sheet. Okay. And if I compare them to another company that doesn't have $200 billion of cash on the balance sheet, then even if everything else looks the same, then that could actually affect its multiples. And so we just have to understand that those non-operating items, if a company has a lot of them, might actually distort the multiple analysis that we're looking for. They can also be used, as I mentioned earlier, for what's called precedent transactions. That's M&A. Matter of fact, if you actually want to see precedent transactions in Bloomberg, go to MA. And that is the historical M&A database of all the acquisitions done over time and the prices that they're paid. And one of the things that you'll see, in fact, I'll show it to you real quick. Jump over here to Bloomberg. All right. Got kicked out of Bloomberg. Back in real quick. I was just checking the equity markets, another 2 to 3% today. It's very depressing. Let's see, come on, Bloomberg, back in. All right, so let's go over here and just type in MA, mergers and acquisitions. And this will show you all the most recent ones, including what's happening today. And then you can also search. So let's say that you're looking at, I'm going to pick a company that does a lot of acquisitions, Pfizer. So if you type in Pfizer, here's all the acquisitions Pfizer's ever done, right? Proposed as well as completed. So here is a $41 billion acquisition that Pfizer made for a company called Seagen. And if you look at the transaction details, get all this information about these acquisitions, timeline, party structure, financing, advisors, stuff like that. But down here, you'll see something called deal comps. These are multiples. Okay. And so one of the things Bloomberg will try and do, this is what the bankers do as well, is they'll say, okay, for companies like Seagen, I don't even know what they do, but probably a biotech. But here's all of similar biotechs that have been purchased. This is when the purchase was announced. This is the value of the acquisition, total value to EBITDA, total value to EBIT, total value to revenue, total value to assets. Okay. So basically, this is a company that hasn't ever made money. So it's hard to value them based on EBIT and EBITDA when they don't make money. But the average early stage company has been paid about 15 times revenue. They paid 21 times revenue. Okay, so they paid a premium for this company for whatever reason. But nonetheless, get a starting point here. And this is essentially called multiples. Matter of fact, right under that is trading comps. Trading comps is another view which says what happens after the acquisition is announced. and basically what happens to the multiples at announcement date and after the announcement date. So again, multiples used part of acquisition. These are called precedent transactions. And again, if you're looking for M&A on anything, you'll find it in the M&A database in Bloomberg. Just type in MA. All right, stop this share. And let's go back to, can I share the trading challenge today at the end of class? Sure, we can look at that before we leave today. All right, so let's go back to the PowerPoint. And again, even precedent transactions have some challenges. You just saw that. Sometimes we don't have information availability about these small private companies. Not all acquisitions are disclosed. If they're relatively small compared to the size of the company, they don't have to disclose the purchase price. So finding true comparables could still be very difficult. And the synergies that are expected are not disclosed in databases. Those are internal numbers. All right, back to multiples. For this class, I have 4 on the slides, but we're going to focus on 3, right? So I'm going to be holding you accountable for understanding 3 multiples and explaining 3 multiples in the analysis that you're going to do in your homework. One is called the price to earnings multiple. The other is the enterprise value to sales or revenue multiple, and the enterprise value to EBIT multiple, right? I'm not saying EV to EBITDA isn't done, but for simplicity, we're going to focus on those 3. Okay, but these are the 4 most common multiples that you run into. All right, so where do these multiples come from? Well, it's helpful to understand the key value driver equation, right? When using it all semester, we use it for continuing value, talking about a lot. So this table represents basically this data up top put into the key value driver equation, okay? And basically 4 elements, the key value drivers. If you remember, we had our profit, we had our growth, we had our ROIC, we had our WACC, right? So assuming a 10% WACC and 100 million of NOPAT, right? If you plug in those ROICs from 6 to 16% and those Gs from 1 to 5%, those are the results of the key value driver equation. So for example, 100 million in NOPAT, 10% WACC, 10% ROIC, any level of growth, you get $1 billion worth of value. Okay. By the way, can somebody tell me why, as the growth rate goes from 1 to 5%, change the G to 1 to 5, in this column, the value is not changing? Why is it in the 10% column, the value not changing? What's going on there? And somebody answered that in the chat, because the ROIC equals the WACC. Exactly. And when you have a 0 spread, you're on the treadmill. And so it doesn't matter what the growth is, the values are going to change. Okay. So here's the point. To the left of this is a negative spread, ROIC less than our WACC. Notice as the growth increases, the value goes down. That's just what we know from key value drivers, just kind of displayed in the table. To the right of the 10% column, this is positive spread, ROIC greater than WACC. As we grow, the value goes up. Okay. So what is a multiple? Well, a multiple, you can see this on the next slide, says, okay, this is the value of the firm. It's called our enterprise value in the result of the key value driver firm. Okay. So basically, basically, if we have 100 million in NOPAT, and let's say our tax rate was 35%, okay, then basically pre-tax, it'd be 154 of EBIT. Okay, so just 100 divided by 0.65. Okay, so we'd have 154 million of EBIT. Well, if I took $1 billion of value divided by 154 million of EBIT, that would trade a multiple of 6.5 times EBIT. So in this industry, a 0 spread would be 6.5 times your EBIT. Okay. So if I told you a company had an enterprise value to EBIT multiple of 6 in this industry, what could we infer? So if there's a company trading at 6 times EV to EBIT, what could we infer about them? What would you say? Yeah, Dylan's exactly right. It would likely have a negative spread. Now, we can't point to exactly which negative spread it is because there's different permutations that lead to 6, meaning I can have 1% growth and 6% ROIC, and that's a 6 times EV to EBIT. I could have 2% growth and about an 8% ROIC, and that's about 6.1 times EBIT. So the point is, there's a range of outcomes, if I were to even draw a line here, that answers the question of what leads to 6 times EV to EBIT. And that's actually a very important insight into multiples, right? So if I told you it had an EV to EBIT of 6, what you probably would understand is it likely has a negative spread at low growth. Now, how negative a spread and how low a growth, meaning I could probably have a range from 1 to maybe 3% G at different ROICs below 10. Any of those could be a right answer. And that's the idea with multiples. That's why we say we think about ranges with multiples, not absolute numbers, because multiple answers can get it. But all of those ranges are in the negative spread category. The same would be true if I told you there's another company in this industry trading at 7 times EBIT, right? So just look at that table and see where the 7s are. Well, here's a 7, here's a 7, somewhere in there is a 7, okay? So this range of outcomes suggests that a company trading at 7 times EBIT probably has a positive spread, 12 to 14, 16% ROIC at a relatively low long-term 1 to 3% growth rate. So that's actually back to multiple analysis. We're doing the multiple analysis right there. What can we infer by their understanding of the key value driver equation about what's going on with the multiples? Okay. And if we're comparing those two companies, one company would have a negative spread, one company would likely have a positive spread. And that's what the trading multiples would tell me, right? Because at the end of the day, multiples are just the key value driver equation. That's all it is. All right. And if you think about the key value driver equation, what's key value drivers? It's 3 things. It's growth, it's ROIC, it's WACC, it's growth spread. Multiples are just a growth spread combination. That's all they are in perpetuity, right? And the biggest difference between a DCF and the multiples is in the think about a DCF model. In the DCF model, we went 5 years forecasting year by year, and then we went into continuing value to forecast the long term. And we use the key value driver to do so. When you do a multiple analysis, you start with the continuing value today, right? You don't do any forecast years. You literally start today and say, as of today, if the company was in continuing value, 100%, what would the value of the firm be? Okay. And so that's why it's a little bit more of a blunt instrument than a scalpel, because at least with the DCF, you can forecast year by year. Well, you kind of know what's going on before you get to continuing value, and 4 values drive the entire value of the firm. When you do multiples, you don't do that. You just go straight to those 4 values, go straight to the key value driver equation to look at the long-term value of the firm. But nonetheless, understanding the key value drivers is key to understanding multiples. Same would be true, by the way, with a price to earnings multiple, right? The only difference is when we apply a price to earnings multiple to the key value driver equation, earnings, PE, EPS is based on net income. It's an equity value, right? NOPAT is not an equity value. It's an operating income value, okay? So we can use the exact same formula for a PE, but we're plugging in, instead of a NOPAT, we plug in net income, okay? And when we think about the G, it's not the growth in the NOPAT, it's the growth in the net income, right? In a perpetuity. And instead of discounting at the WACC, because it's an equity value, we discount the ROE. So ROIC becomes ROE in the key value driver equation. And the ROIC becomes ROE, and the WACC becomes the cost of the equity, because we're discounting at an equity cash flow, not a debt and equity cash flow. So same equation, just plugged in with equity values, get you an actual price to earnings multiple. So for example, on the next slide, same idea, key value driver equation with equity values. So if we had a firm with 100 million in net income and a 10% cost of equity, plugging into the key value driver equation, here's the ROEs from 6 to 16%. Here's the G's from 1 to 5, growth in that equity income. Okay. And if we plugged in 10% ROE, regardless of the growth, at a 10% cost of capital, zero spread. Less than a 10% ROE, just like we did before, negative spread, more than 10% positive spread. And these are the values. So what is a multiple? Well, at a 10% ROE, you take $1 billion divided by 100 million of income, PE of 10. If my growth was 3% and my ROE was 8%, I would take 893. Sorry, mouse trouble today. 893 divided by 100, my multiple would be 8.9 times earnings. Okay. So again, this is also, highlighting the concept that multiples are pretty straightforward. They're based on the key value driver equation. And essentially, our understanding of that will help us understand the multiples. Questions, comments? All right. So why do we prefer enterprise value to price to earnings? They discuss this in the book, but the short answer is, think about this. When we're about to explain these multiples, right? And you have to explain a price to earnings multiple. Price to earnings is based on earnings per share, which is net income. That means everything above net income on that P&L is driving your understanding of the multiple, which means it's a lot to explain. If you do enterprise value to EBIT, it's primarily everything above EBIT. Okay. So the problem with PE is it's easy, but it's also the most difficult multiple to understand, because with an enterprise value to EBIT, what's going to primarily drive it are your operating expenses and your WACC, your cost of goods sold, your SG&A, your WACC. Okay. What's going to drive PE is all of that plus your debt to equity mix, your interest expense. You're also going to have to explain, besides the cap structure, the more the tax impact, because EBIT is pre-tax and PE is after tax. And then the one-time gains and losses tend to affect PE, but they're ignored when you do an operating income for most EBITs, because they tend to be below that line. So the problem with PE is it's just a much more complicated analysis, even though it's probably the most commonly quoted number out there. That's the other reason why we tend to prefer enterprise value multiples over price to earnings multiples. They tend to be a little bit more normalized. They tend to be a little less affected by those other things. And so they're easier to do. Okay. But as I showed you in that present transaction, what if you don't have earnings? Then PE doesn't matter. EV to EBIT doesn't matter. And so we'll use that third multiple, which is enterprise value to revenue, as a proxy to say, all these multiples say, if I generate $1 of whatever, how much value does it create? Enterprise value to revenue, for $1 of revenue, it creates this much enterprise value. Enterprise value to EBIT, for $1 of EBIT incremental, this is how much enterprise value is created. For $1 of earnings per share, this is how much value is created. So that's the general concept of the multiples, okay? But they're driven by the key value driver equation. So here's the other thing. Because they're driven by the key value driver equation, all multiples are just the key value driver equation rearranged. So we'll start with the enterprise value to EBIT multiple. Okay? So this is the key value driver equation right here on the screen. We've been using all semester. And what we're going to do is we're going to try and create an enterprise value to EBIT multiple. So how do we do that? Well, we know that NOPAT, or no plat is EBIT times 1 minus the tax rate. Okay. So we substitute that. And then if we divide both sides by EBIT, enterprise value to EBIT, that cancels out. And we're left with 1 minus the tax rate times 1 minus the growth over the ROIC over the WACC minus G. That is the direct formula if you're trying to estimate an enterprise value to EBIT multiple. It's based on key value drivers. So here's another interesting one. Enterprise value to revenue, also known as enterprise value to sales. So when I sell something, how much value is created? Start with key value driver equation. Okay. So if I want to go to enterprise value to revenue, so then NOPAT is what? It's our revenue times our margin. So revenue times EBIT times 1 minus the tax rate divided by revenue. That's our after-tax margin. Okay, NOPAT margin. So here's the interesting thing. If I divide both sides by revenue, enterprise value to revenue, revenue cancels out, and I'm left with my margin, EBIT margin times EBIT to revenue, times 1 minus the tax rate times 1 minus the growth over ROIC over WACC minus G. Well, that 1 minus tax rate times 1 minus G over ROIC, WACC minus G, is the enterprise value to EBIT multiple. That was the rearranged EV to EBIT multiple. So when you do enterprise value to revenue is our margin, EBIT divided by revenue, times all of that, which is the enterprise value to EBIT multiple. So if you take, which is what we did 2 weeks ago, the enterprise value to revenue multiple, and you divide by the enterprise value to EBIT multiple, you're left with your EBIT margin in perpetuity. And so I told you that that's what we were doing. And I said, trust me, in a couple of weeks in the book and in the class, we'll talk about it. Now we're talking about it. So this is how we were sort of triangulating and using some data from the real world to benchmark what must the margin be in perpetuity based on the trading multiples. Because if you know the enterprise value to revenue multiple and you know the enterprise value to EBIT multiple, then you know what the margin's got to be. And that was the trading range that you did for your valuation projects last week. Because all of this is based on key value drivers. And that's the important thing that you need to understand. It's just simplifying it versus doing it in the bigger DCF, right? So again, highlights. What we're really doing with the multiples is we're working backwards. We're starting with prices and we're saying, how do we explain those prices with the key value driver multiple? And we're going to compare them against similar companies to make sure that we're being reasonable and understand why some companies are trading at higher multiples than others is because of the differences between those companies in the enterprise value. So how does this play out to analysis? This spreadsheet is the one we're going to do the analysis on. This is going to be your next homework assignment. It is in the files folder under a folder called multiples. And there's a file called multiples assignment in class, right? You will need that file to do your next homework assignment, right? So homework 12 is, I click on it and download it. Here's going to be your preview. It's going to be on Costco, Walmart, and Target, right? Now the data is blank because you're going to need the screenshots from Bloomberg to get the data. But basically, step one is going to be taking all the screenshots and filling this template out. It's two worksheets that you download. And then once you put all the data in, then we explain the differences, right? Why is Costco's multiple higher or lower than Walmart? Why is Costco's multiple higher or lower than Target? By the way, a higher multiple is called a premium, and a lower multiple is called a discount. Okay. And so that's what we're going to start getting into next. But what I want to start with is just some quick.
Right, where did you say it is in files? I don't think I see it.
So there should be a folder called multiples.
I don't see that.
Should be right after the midterm exam in alphabetical order. Are you not seeing that? Go back to the, should be right there. You have to scroll down to it. In alphabetical order, midterm exam, practice midterms stuck in the middle. Now,
We don't have
I don't have-
midterm multiples or practice midterms
Yeah.
folders.
oh, you don't?
No.
That's weird. Okay, so let me do this. Make sure this folder is not hidden. Midterm, multiples. Maybe because there's a hidden file in here, it doesn't like it. So let me just delete that hidden file. All right, should be there. All right, does that help? Can you now, if somebody refreshes their screen, can you see this multiples file?
I don't see it. Maybe you need to click upload.
Tell you what, I'm just gonna put in the main directory here. And I'm just gonna re-upload that file. Glad we tested this. All right, so I just uploaded the file again in the main directory. Oh, that's why it's hidden. All right, why that was hidden. It's in two places, but here it is. Multiples assignment in class. And the other one, I unhid that folder for some reason it was hidden. And that's that file. It's the same file, two places. But you'll need that file to do the assignment. All right. So while you're grabbing that file, I'm going to show a completed version from last semester. And talk to you about the analysis that we're going to do. So share. So this is step 2, not step 1. Step 1 is get the data, calculate everything. Step 2 is analyze. All right. So here are a bunch of companies with that template that I calculated last semester. And I'm going to start with these 3 companies: Verizon, AT&T, Comcast. Right. And this is an example, by the way, of both the easiness of the multiples, because these are peers, and the challenge, because Comcast, which is not only a cable network and a communications company, also owns Universal Studios. So, and they own movie theaters, or sorry, movie studios. So, because they own Universal Pictures, and AT&T and Verizon do not. So this is what I mean by apples and oranges, yet Comcast is often compared to Verizon, AT&T. So this is the first page of the template, okay? And so we're going to put in 4 data points that are in the key value drivers, right? We're going to put in their expected net income. Again, I'll talk to you about where to get the data and where it's coming from in just a minute. So we'll put those in for the companies. We'll put in, solve for the G's, put in the expected return on equities in perpetuity, and we'll put in the cost of equity at the time of the valuation, okay? And using the key value drivers, this was the actual PE at the time for each of the companies. And this was essentially what the key value driver equation calculated, which we want to match them. So here's how your analysis would work. Verizon's PE at the time was 8.55. AT&T's PE at the time was 7.52. What that would mean is AT&T is trading at a discount in its PE to Verizon. It's lower. Why? That's the question. So using this data, why is Verizon's PE higher than AT&T's? Key value drivers. We know that net income doesn't. So it's not net income. So remember, key value drivers. Multiples are an expression of growth and spread. So start looking at the growth and the spreads. So the spread for Verizon is negative. All right, 3.9 minus 7.7. the AT&T is also negative, 3.02 divided by 8.2. Who has the bigger negative spread, AT&T or Verizon? Well, this is about 5 points of negative spread. 4.77, 4.7. So basically, AT&T has a bigger negative spread than Verizon. Well, all things being equal, if you got a bigger negative spread, you're likely to create less value and have a lower multiple. So one of the reasons why AT&T is trading at a discount to Verizon is that their spread is worse than Verizon's. Okay, 3.02 minus 8.2 is much more unattractive than 3.9 minus 7.7. Don't get me wrong, they're both bad. Just Verizon's is slightly better, less bad. And that's one of the reasons why they're trading at a premium. This is what you're writing in your 500-word paper. Now, the other driver of this is the growth, right? Verizon is growing the negative spread at 2% a year. AT&T is growing it at 1.5% a year. Those are relatively similar growth rates long-term, but this actually hurts more than that because when you grow with negative spread faster, it makes it worse, but it's not enough to compensate for the bigger negative spread at AT&T. The third factor is the cost of equity itself. When you discount a cash flow at a higher rate, it's worth less. When you discount a cash flow at a lower rate, it's worth more. And so this is the overlooked factor, which is what's the absolute discount rate difference between the two companies. AT&T's discount rate is 50 basis points higher than Verizon, 8.2% versus 7.7. And when you discount those cash flows at 8.2 versus 7.7, they're worth less. So why is AT&T trading at a discount to Verizon at the time? Primarily because AT&T has a slightly worse spread of about 5 points. They're growing that at 1.5%, similar to Verizon's growth rate of 2%, but we're also discounting it with a higher risk of 8.2% versus 7.7%. And that's why AT&T is trading at a discount. It's not much of a discount, but it is a discount. Does everybody follow? All right, I'll do a different one. Here are 3 electric manufacturing companies: Siemens Energy, Schneider Electric, Vestas. Okay, these 3 companies sell industrial gas turbines and other things for power plants and utilities around the world. So why is Siemens Energy trading at a discount to its competitors? Well, if we look at these 2 companies, spread at Schneider is positive, and it's much more positive than Siemens. Schneider, with a 17% return on equity against a 9.5% cost of equity, has a positive spread long-term of about 7.5%. Siemens Energy, 12% ROE minus 9% cost of equity, only has a 3% spread, right? The higher spread, Schneider's growing that higher spread of 7.5% at a rate of about 7% a year, 6.95. Siemens is growing their 3% spread at 5.3% a year. When you compound that over time, Schneider's going to get a higher value than Siemens. So why is Schneider trading at a premium for PE? Why are they paying more for this? Because they're growing their higher spread faster. Now, the one headwind here is Schneider does have a little bit more risk than Siemens, 9.5% versus 9%. Those cash flows are discounted by 50 basis points more, which tends to lower the value. But it's not enough to offset the fact that they have higher growth, higher spread. So Schneider is really about higher growth, high spread, slightly higher cost of capital. That's why they're trading at a premium to Siemens. Okay. What about Vestas? Vestas is trading at a premium to Siemens, 16.7, but not as much as Schneider. Their PE is not as high. Why? Well, they have the biggest spread of the 3. 24% expected ROE against 8.7% cost of equity. That works out to be about a 15.3% spread. Why isn't that leading to such much higher premium? And the answer is because they're only growing that spread at 3.6% a year. Growth is the accelerant. They're not accelerating that growth nearly as much as Siemens or Schneider. Right. And even though they have the lowest WACC, lowest cost of equity here, 8.7, which benefits them slightly versus Siemens and Schneider, problem that Vestas has, it's not the high spread, it's not the lowest risk, is they just lack the growth of their peers, which is why their PE is only 16.7 versus 23.2 of Schneider. Okay. So this is the whole point. What you're trying to do is take our understanding of key value drivers, take real world data, and explain premiums or discounts. This is the PE multiple. You guys just did these valuations last week on these three companies. There were three presentations. I don't know if anybody from the Lilly team happens to be on the call right now. But why is Lilly's PE, even today, higher than these peers? So you look at the data, you tell me. These are perpetuity numbers, key value drivers. Why is Lilly PE 40 and J&J at the time only 13.5, or Merck 13? Why is Lilly trading at so much of a premium? What about the key value drivers is different?
Because of the spread.
Right, they got the highest spread, 60 points of spread, and there's an and here.
Have the highest growth rate.
And they have the highest growth rate. They're growing that 60-point spread at 5.8% a year. J&J and Merck aren't really growing their positive spreads. And so that compounds out over time to be much bigger values, which gives them a much bigger PE. Now, Lilly also has highest cost of equity. So that's offsetting a little bit, but not enough to really damage that PE. But notice, as we go from industry to industry, you start to see differences and nuances in the data. Meaning, if you looked at airlines, even last year, like these PEs are god awful, for lack of a better word. They're terrible. Nobody's paying a lot for these airlines. And the main reason was Delta and American, they had negative spreads and they were trying to ramp up their growth. Well, when you grow the negative spreads, you get really low values, especially with relatively high risks compared to interest rates at the time. They're the highest cost of equities, about 11%. Okay. And so that led to very low values. Southwest has been under investor pressure. At the time, had the best PE in the industry, forward PE, because they didn't have the growth of Delta or American, but at least they had a slightly positive spread, 11.1 versus 9.7. Their spread was about 1.5 points, right? And that actually gave them a better PE because they were at least creating a little value. They were growing. These companies were growing negative spreads and just made their situation much worse, right? Now, again, different industries, different multiples, different growth spread profiles. Questions? Right, following this? All right, let's talk about multiple number 2. And I'll go back to Verizon as an example. So page 2 of the worksheet, it's going to look like this. And you're going to put in the data up here. And then you're going to calculate the enterprise value and enterprise EBIT multiple, which we're going to match. So at the time, Verizon's enterprise value to EBIT multiple was 10.75. At the time, AT&T's enterprise value to EBIT multiple was 11.26. Verizon was trading at a discount. So again, why? Well, if we think about the enterprise value to EBIT multiple, let's go back to the PowerPoint in the book. These are the factors that explain enterprise value to EBIT. Tax rate, G, ROIC, WACC. So you're doing these four things, explain the differences. Okay. So really, PE is a 3-factor analysis. Enterprise value to EBIT's a 4-factor analysis. We break out tax rate. So I go back to the spreadsheet. Okay, so these four things explain this multiple. Right? So why is AT&T trading a slight premium in EV to EBIT? Well, they, on an operating basis, have an ROIC of 4.88 and a WACC of 6.4. Verizon's got an ROIC of 4 and a WACC of 6. That's about a negative 2-point spread. That's about a negative 6-point spread. So at the time, AT&T had a slightly less operating spread, minus 1.6% versus minus 2% than Verizon. And on an operating basis, not a net income basis, they were growing that negative spread slower, 1% a year, versus Verizon growing at 1.5% a year. Well, that slower growth of a slightly negative spread, ironically, made them a little bit more valuable. That allowed them to trade at a premium, 11.26 versus 10.75. Now, the fourth factor is the WACC itself. And AT&T did have a higher WACC, which means their 40 basis point higher WACC, 6.4 versus 6, is hurting their multiple, but not enough to offset that Verizon's growing the negative spread faster. So those are the factors that you're writing about and explaining in your papers when it comes to EV to EBIT. Multiple number 3, EV to revenue. When Verizon sells $1 of product or service, they generate $2.51 of value. When AT&T sells $1 of revenue, they generate $2.30 of value. So Verizon has a premium when it comes to selling products and services. They generate more value. Why? Well, let's go back to our key value driver equation. And there's two things that drive EV to revenue. Number one, EV to revenue is driven by margin. It's very margin influenced. So EBIT margin is key to EV to revenue, all things being equal. But it's also driven by the EV to EBIT multiple, which means it's also affected by growth in ROIC as well. So it's margin as well as growth in ROIC. So it's kind of everything. But margin is a little bit more of a heavy influence into enterprise value to revenue multiples. So with that in mind, why is at the time, AT&T trading at a discount to Verizon EV to revenue? Well, Verizon's pre-tax EBIT margin was 23.3%. AT&T is 20.4%. Given the expected tax rates, 17.9% after-tax margin, 15.6% after-tax margin. So basically, one of the reasons why Verizon, people pay more for their revenue, is they make higher margins on what they sell. They're the premium brand. And it plays out in their multiples. Now, the other factor is ROIC does affect this. And on a productivity standpoint, to generate $1 of revenue, sales, Verizon spending $4.38. To generate $1 of revenue, long-term, AT&T spending $3.21. So AT&T is more productive than Verizon. Verizon is spending more on their network in order to charge the higher premiums than AT&T. Okay, so that's benefiting AT&T because they're not spending as much, but not enough to offset the fact that they're making less. Okay, so those would be the factors that would explain why Verizon has a higher EV to revenue. Okay, why does Comcast have the lowest EV to revenue of all of them? Well, again, despite the fact that Comcast is spending less on their network than the other two, $1.91 per dollar of revenue, they have the lowest margins. And it's that low margin, which makes their sales a little bit less valuable at $1.98. So those are the things you're writing up in your papers when you're explaining the differences. Okay. questions? If I were to go back to the energy companies, Siemens, Schneider, Vestas, template page number 2, EV to EBIT, Schneider, trading at 17.77 times next year's EBIT, Siemens 8.21 on an operating basis. Why? Well, tax rates are fairly similar. Siemens paying a little higher tax rate, 25 versus Schneider's 23. That tends to hurt Siemens a little bit. On an operating basis, Siemens has a negative spread on an operating basis based on ROIC. 8.2% WACC, 7.4% ROIC. That's a negative spread. Schneider on an operating basis is a positive spread, 15% ROIC against an 8.9% WACC. Their spread is almost 6 points. Their spread is -1 point, right? So throwing that higher spread, 6-point spread at 6.42% per year is much more valuable and leads to a much higher EV to EBIT multiple than growing the negative spread at 4% a year, which makes you worth 8.2 times earnings. So it's the higher growth, positive spread, slightly lower tax rate, all three favorable. The one thing that is unfavorable is Schneider is a little bit more risky than Siemens, 8.9 versus 8.2. So that's kind of dampening this. Matter of fact, you could play it out. If they had the same level of risk, their PE would be 24.77, not 17.77, right? But they don't. So that's the headwind to Schneider, the higher risk. But the other factors are more than offsetting it to make them a much more valuable company. All right. Where can we find the screenshots? I haven't put them up there. That's what we're about to do. So I just wanted to give you a taste of how you're going to do your analysis. So you're going to have 3 companies, Costco, Walmart, Target, right? And using data like this, you're going to put it in, then you're going to analyze premium or discount. Why is this column trading at a higher or lower than this column, this versus this? You're going to compare it for both the PE, the EV to EBIT, and the EV to revenue multiple. Okay. Why does Schneider have the highest EV to revenue at 3.3 versus Siemens 0.47? Right? Because Schneider's margin is 19%. Siemens, when they sell something, is only 6%. And if I sell things at 19 cents on the dollar versus cash, and you're selling at 6 cents on the dollar worth of cash, I'm going to pay a lot more for your sales. So pretty straightforward when it comes to why these multiples are different. All right, so let's start out with a blank template. You are going to start out working on 3 companies. Share the template you should have downloaded, multiples assignment in class, but this is basically what you're going to need for homework 12. All right, 2 tabs. First tab calculates the PE. Second tab calculates the EV to EBIT for each of the companies. So you're going to need the data to do this. Right? So what data do we need? PE is pretty straightforward. I need the expected net income, I need the expected ROE, and I need a cost of equity. So we're going to get this from Bloomberg. And again, just because I'm going to jump back and forth a lot, I'm going to try and put them side by side again. See if that works. So share my desktop. All right, so let's close this one out. So I'm going to put this on the left-hand side, and I'm going to put Bloomberg on the right-hand side. All right, so I got Bloomberg over here. Let's just flip the screen a little more. All right, so let's start out with Costco. So you need primarily two screenshots, right, to do this. One is you go to Costco or any of the companies, so do Costco. And the first screenshot you're going to need is the WAC. So I will take a screenshot here, save it. Costco WAC. All right, so this is the WAC. This is the cost of equity. So if I'm trying to type in my cost of equity, 8.5%, 8.5%, right out the screenshot. Now, just because I'm looking ahead, if you go to EV to EBIT, you're going to need the WAC. This is Costco's WAC right here. That's the 8.4%. So since I'm on the WAC, might as well do it for Walmart and Target. So Walmart, US equity on the WAC screen, screenshot, take screenshot, save. This is my Walmart WAC. And as of right now, 8% is Walmart's WAC. And their cost of equity today is 8.3. And while I'm here, third screenshot, might as well get Target. Again, take my screenshot. TGT dash is it? Oh, WAC. Again, for their cost of equity, 8.2%. And for Target's WAC, 7.2. Okay, those are the three screenshots we need to get started. And I put the data in so far. Let me make this a little less big so it all fits on one screen. All right. So then what's next? I need my expected net income, expected ROE. So we'll go back to Costco. And this we're going to get off of our EEO screen. All right. So this is the data we're going to need. But basically, we're going to need second forward year data. Kind of talked about this before. This is last year's actual on an annual basis. This is next year. This is the year after. Make sure you don't accidentally put quarterly data in here or screw up your multiples. Use annual data. And we're going to use second forward year. This is the first clean 12-month forecast. So right now for Costco, their expected net income, FY2, net income adjusted is 8870. Okay. Now for ROE, so I'm going to go ahead and take the screenshot. Call this my Costco EEO. If you scroll down, there's the expected ROE, historical and next 4 years, right? This is the analyst forecast ROE. They don't forecast ROIC, but they do forecast ROE. And so I'm going to call this the Costco EEO2. Just the second half of the screenshot, right? So here's the point. This is supposed to be a perpetuity, right? So what is the very long-term value? Kind of our enterprise DCF, was it assumptions B 6 or 7 value that we would be using for ROE? Well, if we look at Costco, last year they made 30% ROE, this year 30.5, then 28, 26, 26. So I think if I kind of am looking at this, I think somewhere around 26, 26 and a half, we'll say 26, is a reasonable perpetuity ROE for Costco. Now, if I really wanted to do this, I do a DCF as is valuation and get the values from there. But I think that this is a fairly stable company, so it's relatively straightforward. Okay, it's not really changing much over time. Okay, so 26% seems reasonable. And as of the time I loaded the screenshot, their PE for Costco, second forward year down here, is 47.25. Okay. And so our final step, solve for the G. I know these three values solve for the fourth, that makes that PE equal 47.25. And so that would be tools, goal seek, set cell, the PE to 47.25 by changing my G. And the answer is about a 7% G, 6.95%. That's Costco's stock price today, right here. In fact, it says they're worth about 419 billion. Key value drivers, DES. Costco share price times shares outstanding gives a value of 418,697. We're pretty darn close. Market cap. Okay. Key value drivers work. All right. So do the same thing for Walmart and do the same thing for Target. So WMT, US equity. Okay. EEO. Get my values. Save as. This is my Walmart EEO. And scroll down a little. Bottom half of the screen. Walmart EEO2. Okay. So with that in mind, what is Walmart's expected profit off the EEO second forward year? Net income, 23,482. Return equity, same thing, pretty stable. 22, 21, 22, 22, 23. I think 22, 22 and a half, 23, any of those numbers is a reasonable long-term perpetuity ROE. They're pretty stable, both of these companies. And right now their PE, second forward year, 31.05. So solve for the G, tools, goal seek, set cell, the PE to 31.05 by solving for a G, and the answer is 5.95%. So Costco is trading at a premium to Walmart using these numbers. Why? Okay, got to fill out target. So you're going to need TGT, EEO, and I'll scroll down to the bottom to get the expected return equities. Okay, now once you do that, get your data in, explain premiums or discount, Costco against Walmart, Costco against Target using these values just as we did before. Then you start filling out the EV to EBIT. What's left? All right, now here's what's different. I need to know the EV to sales, EV to EBIT ratios. Those are down here in the screenshots. So basically for Target, the EV to EBIT is second forward year, 5 points. I'm sorry, EV to EBIT is 9.9. And EV to revenue is 0.52 in the second forward year. Okay. Now, this is target. If I go back here, let's look at Costco. Costco, EV to sales, second forward year, 1.41. People pay a lot more for revenue at Costco than they do at Target, ironically. And EV to EBIT is 36.18. And for Walmart, you can get the data off the slide. Okay. Now, I need a tax rate. Where do I get the tax rate? Well, option one for Target, GUID. Do they give company guidance with a tax rate in perpetuity? I need a perpetuity rate. Yes, they do. 23.5%. We know this from our previous assignment. TGT, GUID. So 23.5%. And I'll do Costco real quick. Costco also, I believe, gives tax rate guidance at 26%. Put that. And I'll take the screenshot. GUID and I'll get Walmart, even though I'm not going to put it on the screen. You guys can transpose data now that you know where to get it from. Screenshot, save, Walmart, GUID. All right. So finally, I need an operating ROIC. This is the perpetuity ROIC, right? Just like we did an ROE long-term perpetuity. Two things. One, ROE and ROIC are similar, meaning you have ROIC times your leverage ratio equals your ROE. Okay. So they should be correlated over time, right? You don't have one going up, the other going down dramatically. Number two, since they're stable, right? Remember, those ROEs aren't changing all that much. Then what I can probably do for these companies is go to the RV screen, go to our spread template. In our spread template, we have an operating ROIC. I'm going to save that. I'm going to call this the Costco or the retail spread. All right. So here's the point. Right now, Walmart's operating ROIC 13.7%. If their ROEs aren't changing, that suggests that that's probably a reasonable perpetuity ROIC. Same thing with Costco. Costco's operating ROIC right now is 28.31. That's probably a reasonable long-term, right? And Target is 12.22, probably a reasonable long-term. Once you put that in, solve for a G. Tools, goal seek. So set cell, EV to EBIT, 2 for Costco, 36.18 by changing the G. And we see it again, 6.85% operating G estimate, which is, this is Costco's share price. Right? Again, following that process, you can figure out the other two. So step one, I'm about to upload these screenshots. This is homework 12. All right. So with all this data, fill out the template. Once you've done that, analyze Costco versus Walmart, Target on those three multiples, put that in a 500-word paper, submit it by Wednesday. We'll discuss this in class. Right? Final questions before we go?
Was the tax rate for Walmart on the screenshot? I didn't see it.
Let me make sure I got you the guidance on there. Right there, 24. So make sure that's in the uploaded files. All right, any other questions?
Where did you get the expected operating ROIC from for Costco?
The RV screen. So on the RV screen, which compares all the competitors, we calculate an ROIC, operating ROIC, using our custom formula. So I use that. Go back to the actual, I'm calling it the retail spread template. There's the operating ROICs. Now, what I'm assuming, and this is a big assumption, is today looks like perpetuity. Okay, because these companies are pretty stable long term. That doesn't always work. Sometimes today doesn't look like perpetuity. Think that challenging assignment I gave you with Delta Airlines, and then you put in what you think the perpetuity is. So this process works for stable companies, right? But these companies are pretty stable. All right, TAs are available as well. Data is about to be there in the next 5 minutes. This is homework 12. See everybody on Wednesday. We'll debrief. Have a good day. Video will be up shortly.